Good morning, good morning, good morning, everybody. It is Thursday morning at 10 a.m. and it is my favoriteest time of the week. Yes, it is time for her investing coffee talk with yours truly, Jessica Perrone. Thank you so much for joining me week after week. It's been such a fun week in her financial IQ land. And as you come into the chat, as you come into the stream, please put in the chat your say hi, let me know you're here and where you're from and sort of what maybe you've been noticing this week. I mean, this week it's been a tough week in the markets, but we're gonna talk about a bunch of things that hopefully will inspire you as well. So I do just really quickly before I go into things, I do like to have some announcements. People have been asking where to see previous episodes. You can see previous episodes on my website, herfiniq.com. If you go to the show tab, you can actually binge watch me. Yeah, you can do it there. And there's a description about all the topics that we are talking about, all the exciting topics. So definitely you can go there and check it out. Let me introduce myself, Jessica Perrone. I am the founder of Her Financial IQ, and I am the mom of 3 teens. Yes, and I am a 16-year finance veteran who's on a mission to make money and investing topics relatable for women and teens. I'm not a financial advisor, but I am an experienced investor, and it is my goal as an educator to teach you all the things that I wish someone would have taught me, growing up. I'm the oldest of 8 children. There was no money in my household. So we did not have that money conversation. I mean, all those topics, never had them here. So it took me, let me see, I'm 45. It took me a really long time. And lots of really wonderful mentors out there to learn everything I have in this noggin that I am sharing with you ladies. It's been a really fun week here at Her FinIQ. Earlier this week in my before investing class for teens, we learned about savings, we learned about compounding interest and emergency funds. So we were talking about that with my teens in the before investing class. And then yesterday, was that yesterday already? Yeah, yesterday, it seems so long ago, in Pittsburgh's Money Talks workshops, we've been talking about good debt versus bad debt and the importance of cultivating your credit score. Now, growing up, how many of your moms said, brush your teeth, take care of your teeth, wash your hair, take care of your skin, right? Like, yeah, that's something that, women will often and moms will often say to their daughters, right? But how many moms say, hey, daughter, make sure to take care of your credit score, right? Eat healthy, but not take care of your credit score. So we're talking about the importance of cultivating and taking care of your credit scores. So that's some really fun stuff that we're talking about there. We're having a great time. Last night, Athena Paquette, she hosted me on the Women Investing Network. And last night we talked about teaching our daughters to invest smart and early. And we talked about how to do this as a mom, even with little or no investing knowledge. So that recording will be going up in the next couple of days. You can always sign up for my mailing list to get alerts on and announcements on all the events that I'm doing and the recordings that are posting and whatnot. Also yesterday was the last day of the Alpha Teen, the Investing Alpha Teen group. So this is the group of teen young ladies who are further along in their learning about investing journey. And I'm happy to say that they all graduated. Yes, they'll be coming back in the fall in Investing Bravo Teens. And in this last class, we went over summer jobs. How many of you guys out there are talking about summer jobs with your teens? It's a great job market for teens. Let me tell you, it's a really great job market for teens this summer. How many? Any ideas of what your teens are going to be doing? Well, there's all sorts of jobs they can do, right? There's the pool, there's babysitting, there's dog walking, right? There's the grocery store, there's camp counseling, all those things that, teens can do and start making money. Now, in my class yesterday when we were talking, oh, there we go. Hey, Karen, welcome. Thank you so much for stopping by. She's saying that both of her daughters are working retail. Now, okay, I don't know. Can I ask you this question? Is it on the table? Is it under the table? Is it under the table? Yeah, that's my question for you guys. Is it under the table? So this was another thing that we were talking about in the teens class. We were talking about what being paid under the table means. Now, you think about this, right? You're like, oh my goodness, these teens don't even know what under the table means, or, a taxable income, right? Like a job where they take taxes out. They don't know about this. So I was explaining, on the books versus off the books, right? Under the table. And we started talking about ways to start investing that money. And yes, believe it or not, your teen can start investing their summer earnings into retirement accounts. Yes, and I'm going to talk about this in a little bit. But the first thing that we discussed before that was savings. Okay, savings rules. So actually, Senator Elizabeth Warren has a book out, All Your Worth, the Ultimate Lifetime Money Plan, And in that book, she writes, the basic rule is divide up after-tax income and allocate it to spend 50% on needs, 30% on wants, and 20% to savings. Okay. Now that is if you're an adult, you have your costs, you have, everything going on. Yes, as adults, we have lots and lots of expenses, right? But as a teen, you are living at home and you basically have no expenses, right? No expenses whatsoever, unless you're charging them back for the electric bill. I know some parents that do that, right? They charge their teens back for the electric bill, or the thermostat wars. Is anyone else having thermostat wars now in these changing climates? Yeah. So I know some parents that actually charge back their kids for like leaving lights on or turning up. Yeah, it happens. So, but if you are living at home and have no expenses, I challenge my teens to save at least 50%. Okay, at least 50%. So what do you do with it? I know you guys are like, you're like, come on, Jessica, tell me, what could they do with it? Oh, good morning, Kendra. Thank you so much for coming. We're actually talking about, good morning, Kendra, since you're just coming in, we're talking about teens and summer jobs today. Yes, your daughter's a little bit too young, but even so, I'm sorry, I got sidetracked here, but hey, Kendra, how are you? So according to CNBC, if your teen has earned income, meaning they're working a job where they're paying taxes on the wages, that's key, okay? Paying taxes on the wages as opposed to being paid under the table, they are eligible to open Roth individual retirement account. Yes. So your teens can actually, you can open up the Roth for your teens. They cannot open it up on their own, but you can do that. Okay. So with that said, so awesome, Karen. So this may be another trick for you too, Karen, as well. So listen to this. You might want to check this out because you can actually host a Roth in Wealthfront. You can host a Roth in a retail broker like TD Ameritrade, or you can host your Roth with a financial advisor as well. So these are all ways that you can do it. And again, investigate it, learn about it. I'm giving you the facts so you can go and start investing as well and investigate it. So these are the facts and actually CNBC and Investopedia have really great articles on the topic. You can Google it for a lot of specifics, but here are the basics, okay? So anyone with earned income, on the books, taxable income, can contribute to a Roth IRA regardless of their age. So Kendra, those cute little, kids of yours, if you have them in modeling and they're earning income, guess what? You can start investing in a Roth IRA for them. You can start investing them in a Roth IRA for themselves. Does that make sense? Yes. So that's it. And then, so another bullet point here is for 2021 and 2022, workers can contribute up to $6,000 a year to a Roth IRA. Now, we're saying we're specifying the years here because it does vary year by year. So just keep that in mind when maybe if you're listening to this recording in 2023 or 2024, that the contribution amount could change. So yes, your teens can actually invest up to $6,000 a year contribute $6,000 a year to a Roth IRA. Now, this is another stipulation though. The contribution can only be as large as the individual's earned income. Okay, on the books earned income, taxable earned income. Okay, so if your teen has made on the books $3,000, right? They can only contribute up to $3,000 to this Roth IRA. However, a parent can contribute as well. Okay, so you might do incentive for your teen and say, okay, I will match you anything that you are saving. So say your teen makes $3,000, right? And they contribute to their Roth $1,500, right? Well, there's still $1,500 that is allowed to be contributed. So you as a parent are able to contribute the additional $1,500 into there. Isn't that interesting? Now, what is also interesting is that it is taxed on the way in, not the way out. Okay. So if your teens take it out at retirement, right, they will not pay taxes. There won't be taxes on the gains. That's the other benefit of these Roths. So, well, so that's great, right? Isn't that cool? But let me actually run these numbers for you of what that means. If a teen starts investing into a Roth at the age of 15, I actually ran the numbers to show some estimates of what that potentially could be worth. Yeah, at retirement. So let me show you. So basically what I did here was I went to NerdWallet and I put in the compounding interest calculator two ways. So the first way I put it in was is if someone has put in $6,000 contribution every year for 50 years. Okay, so I'm thinking they start at 15 and then they're going to retire at 65, and that's what this account has the potential to achieve. Okay, and it really does depend on the rate of return. Now, I am using an estimated rate of return. Exactly what that will be in the future, we don't know. We don't have a crystal ball for that. Now, I've seen financial advisors use the low side of 6%. These articles that I was reading, they use 7%, they use 8% rate of return. Yesterday, I looked at SPY's rate of return for the last 10 years, and they were looking at an average of 13% if you, for example, invested in SPY, which is the S&P 500, the ETF that follows the S&P 500 index. So as you can see, there's all different types of rate of returns that is possible to input into this equation. What the rate of return I put in there was 7%. I was more on the conservative side. So basically, if your teen starts at the age of 15 and maxes out their account, their contributions every year at $6,000, right, for 50 years, with compounding interest, right, at 7%, their future balance, get this, $2,786,658. Way to make your teens millionaires, right? And when you see those things on TikTok, you're like, be a millionaire by retirement. That's how you do it, right? It is putting money away. Now, I also did it a different way. Okay. I also did this a different way. Now say a person does not start contributing until 35. Okay. So I put in 20 years into this calculator. Okay. The compounding interest calculator. So instead of 50 years, we're only contributing for 20 years. Okay. And at a 7% rate of return. So again, that's the estimation, the estimating a 7% rate of return. Basically, that brings them down, okay, to 652,000. Just over 652,000. That's significantly less, right, ladies? That's significantly less, okay? So, it's a big difference that having your teens start investing in their retirement accounts and contributing to their retirement accounts early makes such a big difference. And I just showed it to you in the numbers, right? Now, like I mentioned, the parents need to open up accounts for kids, okay? But the account can be held by a retail broker that's typically self-directed, or a robo-advisor like Betterment or Wealthfront, or even a financial advisor, where those types of the robo-advisor and the financial advisor, they actually invest it for you based on various factors. Okay. Now, there are a few rules of thought of which type of account to put these into. Okay, whether it is a managed account or a self-directed account. And these are my thoughts on it. And of course, as a parent, and having that conversation with the teen, you can kind of figure out what you want to do. But some people say, let your kids make mistakes young and let them do self-directed, right? I've heard that train of thought. Okay. And so you could do that. They can choose what stocks and ETFs to put in that account, in a self-directed account, or, right, you can open it with a financial advisor. Now, the benefit of opening it up with a financial advisor as opposed to a robo-advisor or a retail broker is that they actually have someone that they can call, right? And especially if you are a mom and you're like, I don't know too much about the markets, but I really want someone to be having this conversation with my teen. Well, then maybe that is a really good aspect, an avenue for your family and for your teens. And, I could just see, and I know that financial advisors love talking to kids. I mean, who doesn't love talking to kids, and, they'll think it's fun, talking about, the way that they're investing the money, the return on it, what's going on in the markets. And the teen actually has someone to reach out and have these dialogues with. So again, it all depends on your family and, your philosophies on it. But yeah, these are the ways that you can have your teen start investing their summer earnings. Isn't that fun? I thought that was really super fun. So also another, speaking of robo-advisor accounts, so I was going through my Wealthfront account and I was adjusting my monthly direct deposits. And I noticed a feature in there. Okay. I noticed a feature in there and where they were offering me a credit line on my investing account at a 4.4% interest rate. And I was like, ooh, that's interesting. So you know what I did? I was like, this might be really interesting to my viewers. And I'll tell you why. But what I did then was I called my financial advisor, and you know me, yes, I have various accounts in all different types of places. I am like a squirrel. I'm always looking for the best return. That's me. Yes, I am. Anyhow, I was intrigued. So I reached out to my financial advisor and I asked her if her company offered it as well, or if it was just like a Wealthfront or a robo-advisor thing. And she confirmed that yes, they do as well, at even a better rate of 3.41%. And again, this is on non-retirement accounts, okay? So does anyone know what I'm thinking here? Where I'm going with this train of thought, where I'm like, which rabbit hole I went down when I started thinking about this? Anybody guess? Okay, so what I started thinking about And especially in a market downturn, when the stock market is selling off like it has been, right? It's kind of scary times. And an emergency happens. An emergency happens where you need money, right? But you don't want to take monies out of your investment account at a loss, right? And you don't necessarily want to put it on a credit card with a high interest rate if you can't pay it back. So it's always nice to know what your options are. What options are available to you in case of an emergency, right? And I would definitely say that a 4.4% interest rate, or even better, a 3.41% interest rate for an emergency is a lot better than a 20% interest rate on a credit card. Of course, that you can't pay back. So we're talking about emergencies. You need money, and you need money fast, right? And the market has sold off, and you can't take it out, right? So this is one of your options. You can put it on a credit card, high rate. You can take a line. You can get a line of credit, 4.4%. Yeah. So options, and know that this type of is available for your investment account that is non-retirement. Yeah. So isn't that interesting? That's good to know, right? It's always nice to know what your options are. Okay, so talking about options, very little options for people on the gas front. Yesterday, I went by the pump and it was over $5. I was like, holy guacamole. Holy guacamole. I couldn't believe it. I really could not believe it. And that is in New Jersey. That's $5 in New Jersey. And typically we have historically, we have, cheaper gas than some other places in the US. Now, the other thing to keep in mind is that if you look at, what you have been spending your money on, right? What have you been spending on? And we've been talking about this, right? We've been talking about how our spending has kind of changed over the last few months. And I've been talking about how even personally, I'm spending more on travel, and I'm spending more on home things, and as opposed to like personal things around the house. So we're seeing that same type of narrative coming out of Walmart and Target earnings, right? And they actually missed their earnings, and that's what contributed to the sell-off yesterday. So what exactly happened? So basically, Target yesterday had a big earnings miss, and this was driven by a shift away from higher margin goods like kitchen appliances and TVs to more basic like food and toiletries, right? And so we were also talking about consumer staples, right? We've been talking about that as well. So Target said that they had felt margin pressure from the consumer pullback as shoppers got more selective about spending on goods. Okay, so that was basically what happened. Now, what's interesting is that there's actually two different narratives, right? That these Wall Street types are talking about as are we going into a recession? Okay, so there's two narratives out there, and I have two examples of what Wall Street is thinking. Okay, so one side is demonstrated by Paul Christopher, and he's the head of global market strategies over at Wells Fargo Investment. And he has predicted a recession around the end of year of 2023. Okay. So what he's saying is retailers are starting to reveal the impact of eroding consumer purchasing power. Okay, the consumer's ability to spend is eroding at a faster pace than it was a month or two ago. And we think that pace is going to accelerate further. Okay, so that is, oh my goodness, we call that the bearish, right? That's the bearish. He's like, oh, we're going to have a recession, okay? Based on, there's an eroding of consumer purchasing power. Now, out of Bloomberg this morning, Joe Weisenthal, he had an interesting take, and he's taking the other side here. And this is what I love about, staying on top of my financial news, is all the differing opinions out there. And I think that they're all very interesting. So this is what Joe was saying. So Joe says, for all the fear and market carnage, evidence of an actual recession or major economic downturn remains scant. So he's saying, you know what? I don't think we're going to go into a recession. And this is what Wall Street does. They duke it out on these different topics left and right. Okay. So he's talking about, and then he goes on to talk about Target. And he says, yesterday the stock got absolutely clobbered with its worst one-day loss since 1987. That came a day after Walmart also had its worst day since 1987, okay? But if you read the Target earnings call, you see the issue was not actually some unexpected plunge in consumer demand. So he's saying, nope, we're not seeing an unexpected plunge. He's saying the issue that they cited, they being Target and Walmart cited over and over again, was the speed of the consumption mix, which caught them flat-footed and over-inventoried. So basically, the shift in consumer demand, right? So like you and I, right? Like you and I, we changed our buying habits. And we've been talking about this for the last couple months, but the retails did not anticipate this, right? So they got stuck and they got caught with inventories that do not match the consumer. Okay. So, and then he goes on to quote CEO Brian Cornell. And he basically, the CEO says, while we can't project into the future, I wish I had a crystal ball in front of me. We can tell you what we saw during the quarter and the start of May, where we just continue to see a resilient consumer. Our traffic numbers are up to start the second quarter. They're shopping multiple categories. So what he is saying is that the official story is about consumption mix and not a broad scale consumer retrenchment. So isn't that interesting? I love reading all this analysis by all these smart people. So yeah, I think that Joe may be right. I think so. But again, if we had a crystal ball, we'd know. But the reason why I say that Joe may be right is that Home Depot on 5/17 had really, really strong earnings, right? So people are still fixing up their houses and their gardens, and they are still consuming, right? So we'll see, right? We'll see whether Joe is right on the no recession front, or if Paul Christopher is right, or at the end of 2023. What do you think? What do you guys think? I'd love to hear your opinions, so go ahead and put it in. Okay, so moving forward, there is a formula shortage. Has anybody heard about this? Is it affecting anyone out there? I was actually thinking, that it might be a really good side gig right now for a breastfeeding woman, to help out some babies out there, for maybe women that can't produce enough milk because this formula shortage. That's scary. That's scary because that's our babies. That's our babies that we are talking about. But so what's happening though is that Biden last night invoked a emergency powers to try and boost output of formula, and tapered federal plans to fly. Tapped federal plans to fly in imports. Okay. The House also passed a $28 billion emergency funding bill for the FDA to help alleviate the shortage, though it's unclear if the Senate, it'll clear the Senate. Separately, a top Democrat, I'm not talking very well today, am I? Is set to grill the FDA about plans to reopen an Abbott formula plant without first addressing a whistleblower's allegation about quality issues. So yes. So hopefully we will see some resolutions on this baby formula crisis. But how is that affecting you? How is it affecting you? Put it in the chat. Let me know. I'd love to hear from you. Other things that we're seeing scarcity in is we're actually seeing scarcity in a medical dye that is critical in diagnosing strokes, heart attacks, and dangerous lung clots. You know, the dye they put into your blood so that they can see how things are flowing. Well, it's a GE dye actually, and it comes from a plant in Shanghai that closed in late March under the city's COVID lockdown rules. So that resulted in cutting off the production that supplied an estimated 1/2 of the American market. So according to Bloomberg, GE says they are working to return to full capacity as soon as local authorities allow. The plant is now back at 50% capacity, and GE is flying in shipments from Shanghai and other plant in Ireland that would normally go to the US by boat. Yeah, that's kind of scary, right? Yes, and hospitals are already running low to the point where they're postponing less urgent scans and rationing care. Yeah, so yes, kind of scary, right? Yeah, so keep your heart healthy. Keep your heart healthy for sure. So the other thing that I've been noticing, I've been really looking at is jobs, right? So we're talking about recession, we're talking about strength of the economy. And basically, the strength of the economy is only as strong as the people have money to spend, right? And jobs are making money and money to spend, right? So that's sort of why I've been looking at jobs. And so before COVID, before we had the really strong job market, when companies were doing well, right, and they needed to cut costs, you saw layoffs, right? You saw layoffs and you saw headlines of layoffs coming across. Now, what I am looking at though is how these companies are going to cut costs, right, without laying off. And so what I am seeing is, for example, Meta is saying that they're doing a hiring freeze. Salesforce said they are slowing hiring, and they're also putting a hold on some recruiting. So we're starting to see, people coming off trying to hire more people. Okay, so we're seeing hiring freezes. Okay. But another interesting item that I saw, and this was out of roll call today, is that Congress as Congress negotiates a sweeping bill aimed at making the U.S. more competitive with China, House Democrats and advocates are pushing for immigration provisions that would attract high-skilled workers and boost critical sectors for the economy. Again, we're talking about immigration. We've been talking about this, right? Isn't it interesting how, we're looking for workers, we're looking, to alleviate all these things. So we're trying to attract high-skilled workers, and even, so the House passed legislation with several immigration provisions, including one that would allow more immigrants who have doctorate degree in science, technology, and engineering or math to get green cards to live and work in the US. Okay, so you see Washington trying to figure out how to get more talent here in the US, as there is I'm sorry, I'm really not talking well today. But what I'm trying to say here is that sometimes these legislations can be a little too late. And depending how large they let it in, and then you see these companies saying, okay, we're slowing down hiring, right? So again, it's supply and demand. If there isn't a demand for all these workers and all of a sudden all this supply is coming onto the market, well, what's going to happen to wages? So that was my question when I saw these headlines come together. And this is the way I start thinking. I'm like, well, what is going to happen with wages, right? What's going to happen to wages, and what is going to happen if inflation doesn't come down, right? So this may make the U.S. worker not be able to afford as much as well. So this is a theme that I'm going to be watching for. And it's not going to be immediate. It's not going to be immediate. It's going to be something that takes time to come. When we're talking about legislation, it takes time to come down the pipeline, but it is something that I'm interested in seeing how it progresses and how it sort of works its way through the systems. Now, on a virus front, another virus front, yeah, I picked this one up, and monkeypox. Has anyone heard of monkeypox? I mean, we've just recovered from another virus, but yeah, another virus. It was detected in a man in Massachusetts with the first case of a rare and potentially dangerous virus in the US this year. Oh my goodness. So another potentially dangerous virus. The man who traveled to Canada was in good condition, and health authorities said he poses no risk to the public. Okay. It is the first reported infection in the US so far and follows reports of scattered cases in Europe. In addition, health officials in Canada are investigating up to 13 cases in Montreal. Yeah, so we have 13 cases in Montreal and 1 in the US. So monkeypox, do your research. And yeah, it's kind of weird. So definitely look at it up. So as always, at the end of my broadcast, I like to close with a little bit of, I know, Kendra, not another virus, I know. Inspiration of the day. You alone cannot change the world, but you can cast a stone across the waters to create many ripples. Yes, let me say that again. You alone cannot change the world, but you can cast a stone across the waters to create many ripples. And that's what I'm trying to do here at Her Financial IQ. I cannot change the world. I cannot do that. But I can cast my stone and make ripples for women of all ages and all backgrounds. That's what I'm hoping to do. And I want to start with you. I want to start with you, the viewer here. And I am so amazed at the community that we are building of women committed to financial health and wealth growth and knowledge. I am so proud of all of you. I'm so proud. And I wish you a bright financial future. You may be overwhelmed about getting your ducks in a row, but it is baby steps, and you can do it. And should you wish to take your journey outside the coffee talks, come see me in my panels, my workshops. Of course, keep watching the coffee talks. You can see all of that on my website, herfiniq.com. I'm Jessica Perrone, founder of Her Financial IQ. You've been watching Her Investing Coffee Talk. May the markets be in your favor. Bye now. Take care.